Good morning, good afternoon, good evening. Let's start with the last topic of our part 2 businesses, that is specialized return. In specialized return, we are going to learn about different types of returns which are being filed apart from 1040, 1065 and 1120 S Corp and C Corporation. So let's start with the first, that is exempt organization. If you fall under the definition of exempt organization, you will have to file 990, Form 990 to provide to the IRS about your receipts, your donations which you are receiving, right? What is the definition of exempt organization, right? Operated and organized, those organizations which are operated and organized exclusively for religious, charitable, scientific, testing for public safety, right? Literally educational, for foresting, national, international sports, prevention of cruelty to children, animals, those type of organization will fall under the definition of exempt organization. Okay. Next is qualifying organization will include non-profit old age homes, parent teacher associations, they will be falling under the qualifying organization, charitable hospitals, other charitable organizations, alumni associations, schools, state schools, universities, hospitals, chapter of Red Cross, Salvation Army, Boys or Girls Club, churches, right? All these organizations which are formed and that those are for non-profit purpose, they will fall under the qualifying organization. Okay, so these are the names which we can call as organizations which are exclusively operated. So the nature of their activity includes any of this, okay, and qualifying organization will also include this all types of organizations. Okay, next is if you are an exempt organization, you will have to take exemption. Okay, to take the exemption, you will have to file form 1023. To recognize the exemption, you will have to file form 1023. When it should be filed? It should be filed within 27 months of your formation. Whenever the organization is formed and it is for non-profit and it falls under any of the above mentioned names, right, or the nature of activities involved, any of these activities, then they will have to file form 1023 within 27 months from the date of formation. Okay, if they file within this time limit, then the exemption will be allowed, will be effective from the date of formation. But if 27 month has passed and then you are filing for exemption, then the effective date for taking the exemption will be from the date of filing that 1023 form. Okay, exemption to file 1023 form is for certain organization, it is not mandatory to file form 1023. First is if you are a church, okay, if the organization is having a gross receipts of up to 50,000, okay, not only that, but we'll have to compare first year gross receipt. In the first tax year, see, if your gross receipts are up to 50,000, church is there if your gross receipts are up to 50,000. In the first tax year, you can get exemption only if your gross receipts are up to 7,500. In first total of the first and second year, your gross receipts are up to 12,000, and all the 3 years your gross receipts are up to 15,000. Okay, within this limit your gross receipt will be calculated, and if your activity is a church, then you don't have to file form 1023 to claim the exemption for exempt organization. Okay, form 990 is the form which we are going to file, right? For individual we file 1040, for corporates we file 1120 S Corp, C Corp, or 1065 for the partnership. Same way, if you are an exempt organization, you will have to file form 990. If you don't file the form 990, then what will be the consequences? You will have to pay the penalty, that is $20 per day. Okay, and this $20 is limited to a maximum penalty of 10,500 or 5% of your gross receipts, whichever is lower. All right, if your gross receipts are more than 10 lakh, 1,94,500, right? Then in that case, the penalty will be $105 or 54,500, whichever is lower. Okay, depending on your gross receipt. See, normally the penalty is $20. They don't ask you the penalties in part 2 chapter, part 2 paper. Okay, so just need to remember this for part 3 paper. If you fail to file form 990, the penalty per day is 20, but that is limited to maximum 10,500 or 5% of your gross receipt. And if your gross receipts are over and above 10,94,500, right, then in that case the penalty will increase to $105 or 54,500, whichever is lower. All right, now one question will be there from this topic. The type of form number will be asked. 990 PF is related to private fund, right? They are also exempt under section 501c3. They will have to file form 990 PF. There will be one question on 990 EZ and 990 N. Okay, 990 is for all other exempt organization. 990 is the basic form which all the exempt organizations will use. 990 PF is simply for the private fund. 990 EZ is what? It is nothing but a small exempt organization and non-exempt charitable trust who are having a gross revenue of up to $2 lakh. Okay, and total amount at the end of the year is up to $5 lakh. Okay, so if this criteria of the gross revenue fulfills, and if it's a small exempt organization, and if it's a non-exempt charitable trust, it's a charitable trust but it's not an exempt, it doesn't fall under the definition of exempt, then they will have to file 990 EZ. Okay, 990 N is nothing but it's a tax exempt organization who is having a gross revenue of up to 50,000. Okay, up to 50,000 the gross revenue is there. And for filing 990 N, the due date is due by 15th of 5th month. So it is 15th of May, and here also will get extension of 6 months, that in by filing just a form 8868. All right, so 990 is clear. It's just an informational return. You will have to identify whether the organization needs to file 990 PF or just 990 EZ. EZ is what? For the small exempt organization. Remember this thing, there will be one question on 990 EZ. Small exempt organization whose revenue is up to 2 lakh and the total amount at the end of the year is up to 5 lakh. Okay, and 990 N is something which is having a gross revenue of up to 50,000, and 990 N will have to be filed by 15th day of the 5th month, that is 15th of May. Okay, now next is 990 T. What is 990 T? It's unrelated business taxable income, right? Income from trade or business is there, and if it's more than 1,000, okay, if you have a income of more than 1,000, then you will have to pay estimated tax payment for the year of expected tax of more than 500 per quarter. If you're expecting a tax to be paid for more than $500 per quarter, then you will have to file, you will have to pay the estimated tax and file 990T in addition to the annual information return. So along with 990, if you have to pay estimated taxes, right, then you will also file 990T. When the 990T will apply, if your income is more than $1,000, right, plus your estimated tax payment comes to an amount which is more than $500. Okay, so this is about 990. This is the simplest one. Only form numbers will have to remember in this. And what are the deadlines or due dates for 990N? Let's start with the next topic, that is Decedent's final income tax return. This topic is important because there will be 1 or 2 questions from this topic. Let's start. Whenever there is a, the decedent who is dying in a particular year, for that year, we are going to file a normal 1040 return. Okay, but in the next year, we are going to file a final income tax return. So it will be a 1041. Okay, let's say for example, the death occurred between Jan to April 2022. Okay, so during the whole 2021 tax year, he was alive. Okay, so for 2021, for 2021, we are going to file a normal 1040 return, right? And the due date will be the same that is applicable to the other individuals, that is 15th of April 2022. All right. But if the descendant dies before the year, like for example 2021, he was alive, so we are going to file 1040, right? For 2021, we are going to file 1040. But for 2022, we are going to file a final income tax return 1041. Okay. If the descendant is married, for example, at the time of death, then the descendant and the surviving spouse are considered as married for the whole year. So this you have learned in the part 1, that like if the descendant is was married, the spouse will file MFJ, right? Filing status will be MFJ. So same way, the descendant will also be filing a MFJ for the whole year, because he was married during the year, but he died in the next year. Okay. Now what all incomes will be included in his income, that depends on what method the descendant is following while filing the tax return. That is either cash method or accrual method. If it is a cash method, then you will have to consider only those incomes which are actually received. There will be a confusion whenever there is a declaration of dividend or some other incomes which is declared and then received on later date. So when the death occurs between the declaration date and whenever we receive the amount in a mail, right, between that date, if the death occurs, then you are not going to include the income, because it is just declared, you are not yet received if you are following a cash method. Okay. So whatever is the income, right, which is going to be included in the tax return of a descendant is called as income in respect of descendant. So this income in respect of descendant will be included in the final return. Now there are two types of income which taxes which the descendant will pay. It will be on the capital asset and other assets. So if there is a capital asset, right, then the descendant will receive a step up on that asset. Means whatever is the cost price, we'll compare it with the FMV. Whatever is the adjusted basis, I can say, we'll compare it with the FMV. So we are going to record it at FMV. So whatever is the difference, it is called as step up. On this step up, the descendant will have to pay tax and will have to include it in their tax return. Okay, so it's a capital asset. Other assets are like traditional IRA, right? It will be transferred in kind to the beneficiaries. Whoever are the beneficiaries listed for the traditional IRA, it will get directly transferred to that beneficiaries. So they are not going to receive a step up adjustment. Only whatever is the amount transferred to the beneficiary will be included. Okay. Beneficiary is responsible for paying tax on the income from this asset. So whoever are the beneficiary who are receiving the benefit of that asset, we be paying the tax on those income. Okay. Now income in respect of descendant will be shown in whose tax return. So if the descendant is having an estate, we'll see how the estate will be formed. See what happens now. Whenever there is a death, all the assets are transferred. Whenever there is a death, all the assets are transferred to an estate. Okay, just a minute. All the assets are transferred to an estate. Now what this estate does, this will allocate the assets to various beneficiaries who are listed. All the beneficiaries who are listed on the will or on the at the time of transferring the asset, it is decided already that this will be divided into beneficiaries to certain percentage or ratios, or directly the income will be transferred to the beneficiary. Like for example, traditional IRA, if the nominee is or beneficiary is the spouse, then the whole traditional IRA will get transferred to the spouse. Okay, so these are the examples. So whenever there is a death, in the year of death, we will file 1040. Right? In the next year, we are going to file 1041. Okay. So for example, if a person died between Jan to April, right, 2022. So for 2021, we are going to file 1040, and for 2022, we are going to file 1041. So now what happens? All the assets are getting transferred to the estate. So what estate will do? Estate will file a form that will be filed to the IRS giving the information of all assets. Also, it doesn't happen like it might take time to distribute all the assets, right? It will not take just 6 months or 7 months. It might take 2 years or 3 years to distribute the asset to the beneficiary. So each year, whenever the estate is earning the income on that assets which are held in the estate, at that time the estate will have to file a tax return showing that what was the income, and taxes, estate taxes should be paid by the estate which is formed. Okay, this we will look in the stepwise manner. Let's move forward. So capital asset and other asset. What are the IRD? IRD means what? Income in respect of descendant. Okay, so income in respect of descendant will be included in the income of descendant's estate if the estate is receiving it, right? Right now I have explained the example that how the assets will be transferred. So if it's an estate, the estate will receive the income, they will charge tax, right? They'll have to pay the tax on that income. If the beneficiary is receiving, if the right is already transferred to the beneficiary, if the right is passed, then directly the beneficiary will pay taxes on those income, will include those income. That IRD will be included in the beneficiary's income tax return. Okay. Next is any person to whom the estate properly distributes the right to receive it. Whoever is the person, like whatever is the distribution over here, if the income has already been distributed, then that income will be included in the beneficiary's tax return and not the estate's, not the descendant's tax return. Okay. Next is the executor. See, the estate, whenever all the assets are getting transferred, there will be one executor which will be appointed who is going to allocate the asset, right? All the assets are getting transferred to estate, the executor will be appointed. The executor will have to file form 706. Okay, the taxpayer who must include the IRD in his gross income may be able to claim the deduction of estate tax paid on the income. So see, again I am going to explain this thing. There is a death. Okay, in the first year the descendant is going to file 1040, right? The descendants, beneficiaries, or whoever are representatives, they will file 1040. And then 1041 as a final income tax return. Okay. Next, all the assets will get transferred to an estate. This estate will be handled by will be operated by a executor, representative, or an executor we can say. Okay, so whoever is the executor, he is going to file form 706. All right, and this 706 is filed for the first time showing the all the assets, all the incomes of IRD, right? And then the estate will distribute the income to the beneficiaries. Now what happened, whenever 706 is filed, along with that, if any estate tax has been paid, right? Or it might happen that estate is filing a form each year, like for example, first 6 months the estate's assets are not yet distributed. 1 year also it is not yet distributed. 2 years also it is not yet distributed. So each year, whenever the estate is filing the form to the IRS showing all the details of the incomes and expense on the assets held in estate, estate will pay a estate tax. So whatever taxes that estate has paid, the beneficiary, when they are including that IRD, the portion of their IRD in the income, they will get a reduction of the taxes which are already paid. All right, they will get a deduction on that. Okay. There are now two types of deduction which estate can take. This is important. If the descendant has incurred a medical expenses and if that was paid before death, right, then anyways it is deductible on the 1040 return. We can take it as a medical expense as a deduction on that respective 1040 return, on the final return. Okay, but if it is not paid, for example, it has incurred but the expenses are not yet paid, what will happen? The liability will be recorded in the estate's form, that is 706. We will record it as a liability. Now within like within a certain period, that is 1 year from the date of death, if that liability is paid off by the estate, right? If the estate pays the medical expense during 1 year, then what will happen? Executor may elect to treat all or part of the expense as paid by the descendant rather than 706. Means that will be allowed as a deduction in descendant's tax return 1040 return. Got it, guys? Whenever there is a medical expense incurred and paid by the descendant before death, then anyways he is going to get the deduction. But if it is not paid and the estate is paying it within 1 year from the date of death, then that will be included as a deduction, that will be included as an expense and will be deductible in the 1040 return and not on the estate return. But if more than 1 year has passed and now you are paying the expenses, then the deduction will be taken by the estate only in the form 706. Okay. Next is loss deduction. So if there is a net operating loss or a capital loss, do you remember in NOL and capital loss we used to carry forward and capital loss we used to carry back and carry forward. So that is not allowed. If the descendant, whatever loss you can take, you should take it in the final tax return, right? But if there is any pending loss, you are not going to carry it to the estate tax return. You are not going to carry it to the 706, or you are not going to allocate it to the beneficiaries. It is not allowed. Okay, so loss deduction is only allowed till the last tax return which is filed by the descendant. Credits will be applied to the descendant before death on the descendant's final return. Same way like a loss, it cannot be carried forward. Credits cannot be carried forward to the estate return, that is 706, or it cannot be carried to the beneficiaries. Only on the last final return which you are filing, you take as much as credits you want, as much as deductions you want. Remaining credits, remaining deductions, remaining losses will be lapse. Okay. Let's start with the next topic, that is estate income tax. Now we have done the 1040 descendants final return. Okay, so 1040, after filing 1040 there will be a 1041, and 706 we have already done, that is a distribution of asset to the beneficiary. When the estate will distribute the asset to the beneficiary, we are going to file 706. Okay, so what does estate income tax means? Means whenever there is a if a person dies, right, there will be a probate proceeding that will open depending on the various state laws, and it will open within 30 days to 90 days from the date of death. So within 30 days to 90 days, what is the first thing that needs to be done is to appoint a representative, right? Executor, or I can say representative. If the representative is not appointed, then what will happen? Whoever is handling the assets, whoever is having the possession of the property, right, they will be responsible for filing 706. Okay, so it will happen that every time there will be a first step will be the appointment of the representative. That representative will account for all the assets of the descendant, right, in one estate, and that estate will form file 706 showing that these are the value of the assets, these are the step up basis of the asset, and the difference of the value adjusted basis and the step up, there is a difference that is called step up, which will be paid by the descendant. The descendant will pay tax on that. Okay. Next is primary duty of personal representative. What is the primary duty? First and foremost, they will have to apply for EIN. If estate is required to file the return, right? 706, if they are filing, they will have to have an EIN, right? You cannot file it using SSN number. You will have to get an EIN number. File all the tax return when it is due. Then they will have to pay taxes determined up to the date of discharge from the duties, right? Till that date, they will liable to pay taxes. Filing requirement, first is personal return, final descendants income tax return, which will be filed as a final 1040. Then there will be estate tax return, that is 706. Tax on transfer of asset. Whenever the assets are getting transferred, they will have to pay. Then there is a personal return 1041. If asset generates more than $600 of income, right, then they will have to file a income tax return for estate, that is 1041. See, 706 is just an informational return. Again, I am explaining. 1040 is filed. and then whenever the estate takes the hold of the assets, right, and whenever they are transferring the asset, all those will be listed in 706. But whatever income that estate is generating, from the property, they'll have to pay tax on it, and that tax will be paid by filing form 1041 each year whenever they generate an asset. And if that income generated is more than 600, right, then they will have to file 1041. Are you guys clear? Usually people get confused between these three forms, 706, 1041 and 990, which we have done already, exempt organization. So don't get confused. This is just informational return which will show that whatever assets are allocated and what all assets are acquired by the estate, and then it will be distributed, right, to the beneficiaries. And whatever income which the asset is generating will have to pay tax. The estate will pay tax by filing 1041, and the beneficiary will get the benefit of that taxes paid. All right. Next is 2022 tax rate schedules for estate and trust. If the taxable income of that estate is up to 2750, the income tax rate is 10%. If it is 2750 to 9850, it will be 275, that is 10% on 2750, and over and above that 24%. 2850 to 13450 is 1979 plus 35%. $13450, if it's more than $13450, right? Till last year this limit was different. In 2022 this limit has changed. So more than 13450, if you're having a taxable income for estate or for trust we are going to do right after this topic. So for trust and estate, if your income is more than 13450, then you are going to pay an income tax at the rate of 37% plus $3146. Okay, there can be one question from this table, just like what is the highest limit, I can say, what is the highest limit on which the tax will be applicable. So that is 13450. So over and above this, your percentage is 37%. Just remember this last one. Okay. Next is exemptions and deductions on form 1041. So whenever you're filing 1041 now, like you are paying taxes, right, on the incomes which are generated from the asset. So it is not fair that no deduction is allowed. There are some deduction which will be allowed, that IRS allows you to take certain deduction based on that income. So estate is allowed an exemption of $600 is a standard exemption, I can say, which will be allowed only for estate. This right now we are talking about estate, not trust. Okay, trust is a totally different thing. Estate is a totally different. Estate is something what fifth time I'm explaining. Whenever there is a death, all the asset will be transferred to the estate. The estate will form file 706 to just give the information to the IRS that what are the asset getting transferred. And whenever there is a transfer to the beneficiary, it will be recorded on 706. If the asset generates the income of more than $600, then they will have to file form 1041. Okay, while filing 1041, they get a standard exemption, that is $600. Okay, second exemption that they are going to get is a charitable contribution. So if the estate is giving some amount as a charity, donating some amount, then it will be allowed only if two conditions are satisfied. Allowed only if specifically provided in the will. So if a descendant, right, is mentioning that this much amount should be provided as a charity, then only it will be allowed as a charitable contribution in the 1041 return. Plus it should be paid out of the gross income of estate. What is gross income? Whatever income the estate's asset are generating are the gross income. So it should be paid out of the gross income, or it should be permanently set aside, right, for a qualified charitable organization. You remember, like every time you are paying from the gross income, or else you just accumulate one amount at the starting of the year and you say that it will be donated from this separated amount. So it is permanently set aside, or if it is paid from the gross income and it is mentioned in the will. Okay, qualified conservative easement grant, this type of grants which you receive are not allowed after the date of death and before estate tax return. Okay, after the date of death and before the estate tax return is filed, between that, if you are receiving any qualified conservative easement grant, then that is not allowed. Losses, as I earlier mentioned, losses are not allowed, but only two types of losses were there: NOL and capital loss. That is not allowed in estate return, right? That will be allowed only on the final descendants return. But if the loss is related to the sales of property, if any asset of the estate is there that has been sold, and in that case there is a loss, then the estate can claim that loss. Okay. Estate and beneficiaries are considered related for the purpose of loss on sales of property. So now you have to apply the provisions of related party transaction. Do you remember? For example, estate is there and the beneficiary is there. Okay. So whenever estate is selling the asset and incurring a loss, right, and that loss will not be taken by the beneficiary, but why? Because they both are considered as a related parties, right? So whenever the beneficiary sells the asset further, whenever the asset is been sold further, whatever is the gain, out of this gain, the previously disallowed loss will be reduced, and this amount will be considered as an income for the beneficiary. Net, I can say, will net off the gain with the disallowed loss, which was previously disallowed, right? In case of law, there will be one question, guys, from this topic. If there is a loss and if it's between the estate and the beneficiaries, the loss will not be allowed at that time, but it will be allowed when the beneficiary sells the asset further. Whatever is the gain, we are going to reduce that disallowed loss from the gain, and the remaining amount will be taxable. Got it, guys? Next is casualty and theft loss. Obviously, this will be allowed. If there is a casualty or theft loss, like of any asset or property, then it is allowed to the estate only if not claim on 706, right? Whenever they are filing 706, at that time, if they have not claimed that loss, then it will be allowed to the estate, 1041 form. Administrative expense can be deducted either from the gross estate, right, or from 706, depending on like whichever tax return you are taking. Like either you can take it on 706 or on 1041. You can't take the administrative expense on both the forms. You have to just take it on any one of them. Okay. Depreciation and depletion will get apportioned between the days, right? A portion is allowable for the depreciation and deduction that accrues after the date of death between the estate and the beneficiary based on the income of estate that is allocable to each beneficiary. So let's take 1 lakh was the income, and there are suppose two beneficiaries, both will get 50k 50k. So if the depreciation is 10,000, it will be allocated between the two beneficiaries in the ratio of the income allocation, that is 50-50 it will be allocated. So 5,000 A beneficiary can take, and the rest 5,000 B beneficiary can take as a depreciation deduction. Okay, it will depend on the allocable on the based of the income of the estate which is getting distributed. So based on that gross income, we are going to allocate the depreciation deduction. Next deduction is distribution deduction, limited to the distributable net income. Okay, distribution deduction. So when the estate is distributing its asset, right, they are not liable to pay tax on whatever is distributed. So that asset which has been distributed or that income which has been distributed will be added as a deduction for the estate. Got it, guys? So it will be limited to the distributable net income. Estimated tax will have to pay where it is due 15th of April. And if you want to file an extension, so normally it is 6-month extension for any of the other tax filers, but for estate it is a 5.5 month of extension. Okay, if the tax year ends more than 2 years after the date of death. So remember, whenever there is a distribution, it might happen that it takes 1 year or 2 years. So if it is taking more than 2 years to get the asset distributed, in that case, what will happen? If more than 2 years it is taking, then you'll have to follow the individual estimated tax due date. So estate will have to pay estimated tax, and you'll have to follow the 1040s deadlines. Okay, that is 15th April, September, Jan and June. These are the due dates on which estimated taxes are to be paid. Okay, but if more than like within 2 years your assets are getting distributed and everything, then you'll have to just pay a single payment full when you're filing the tax return, that is on 15th of April, right? And like they can follow either a calendar year or a fiscal year. So distribution deduction, they can get a net distribution, whatever they are distributing, they can get up to that amount. And on each, whatever is the income left, they will have to pay the taxes. That will depend on the tax year. If the tax year is ending for more than 2 years, right, after the date of death, then you'll have to follow the deadlines of the estimated tax payment of the individual returns. That is 15th April, September, Jan, and June. And more than 2 years, it's not ending within more than 2 years, and it's ending within 2 years, I can say, then only single payment you will have to pay as an estimated tax, that is due date of 15th of April. And if there is an extension, just add 5.5 months to it. All right. Next is distribution to beneficiary from an estate. So there are two bifurcations over here. Beneficiaries of estate that must distribute all the income which they are earning currently, and second type of estate can be beneficiaries of estate that does not have to distribute all the income currently made. So there can be a two bifurcation. Whenever the estate is formed, they can make an arrangement, that make an agreement that whatever income is there, they are going to distribute it. Or second, it's not necessary that all the income will get distributed, some part will get distributed, right? So let's talk about the first case. If they have agreed to distribute all the income, means the beneficiaries of estate that must distribute all its income currently, then they will have to report their share of DNI, distributable net income. What do you mean by DNI? It's a distributable net income. Okay, so whatever is the income, you are going to distribute it. If you have agreed that it is going to be distributed, whatever is the amount, for example, you have earned $1 lakh, right? So whole $1 lakh will be distributed, and the beneficiary, what beneficiary will do, whatever, whether it is distributed or not, since they are following this, whether it is distributed or not, they will have to report the share of DNI in their income tax return. But if they are following the second method, that is beneficiaries of estate that does not have to distribute all the current income, then what they'll do, report all income that must be distributed to them, right, plus all other amount paid, credited, required to be distributed up to their share of DNI, distributable net income. Okay, so they will have to report all the income. See, if they fall under this category that does not have to distribute, then they will report all the income that must be distributed. So add all the income plus all the other amount paid along with the income, if there is any additional payment made to the beneficiaries, so that amount paid, credited, required to be distributed up to the share of DNI, those two income will be added. Okay, there will be no practical question from this topic, but just remember the type of estate. First is report just the share, just their required share in their income. Second is, if they are falling under the second category, they will report all the income that must be distributed to them, whether or not actually distributed, plus all other amount paid. Okay. Next is request for prompt assessment of tax. Now what happens? IRS can assess your tax, right? So what you can do, you can ask the prompt assessment, means early assessment of your tax, because since there is a closure, because estate tax return has to be filed like within 2 years, or maybe within 1 year, or maybe within 6 months. You can ask the IRS to assess the tax, okay, in advance. Okay, so settlement of tax liability of estate earlier, then earlier, it means what, more than 18 months from the date when the return request was received. The IRS can assess the tax within 18 months from the date when you are requesting the IRS to make the assessment. Okay, so this was about estate taxes. Okay, just go through it. This is an important topic, estate income tax, and before that we have done the descendant. So descendant and estates are interlinked. Okay, so just go through the topic once, then we are going to start with the trust. Okay, so next topic here is regarding trust. What do you mean by trust? Trust is something where all the assets are getting legally transferred by way of legal agreement under the federal law. Okay, where one party is going to manage all the property for the benefit of other. All right, for the benefit of other, they are going to manage all the assets. Now there are two types of trust. Whenever a person is alive and that person himself is forming a trust, himself transferring all asset in a trust, then that is called as inter vivos, that is called as living trust, I can say. Next is testamentary trust, means at the time of death when the trust is created. According to the will, if it is mentioned in the descendants will that all the asset will be transferred in a trust and it will get like the benefit will be provided to the different beneficiaries, then that is a testamentary trust. Okay, so primary beneficiary, primary parties to the trust, how we can define as grantor, there can be a beneficiary and there can be a trust. So what do you mean by grantor? Grantor is nothing but a person who creates the trust and who transfers the trust assets and contributes the property to the trust. What do you mean by beneficiary? A person who is going to receive the benefit from that asset which is being transferred by the grantor. Then there is a trustee, means a person who is responsible, fiduciary responsible for all the asset. He is going to handle, he is going to manage all the assets. So that is a trustee of the trust. Okay, and the trustee is also responsible for the payment of trust tax and accounting for trust income. He is going to handle everything, all the admin part. He is going to file the tax returns. He is going to pay the income taxes and everything. Next is let's start with the type of trust. This was the beneficiary, like parties to the trust. Now let's see what are the type of trust. There are three type of trust, I can say. First is grantor trust, second is simple trust, and third is complex trust. What do you mean by grantor trust? Grantor means a person who is transferring all the asset to the trust. So grantor retains the control of his interest as a beneficiary. He is also transferring the asset, also is a beneficiary to the trust. So that type of trust is called a grantor trust. So grantor has a revisionary interest. He can dispose the asset whichever he wants. He can acquire the asset. He can take the distributions, right? So grantor is a he gets the beneficial enjoyment. Grantor retains certain administrative power, like disposing or borrowing. Okay, grantor has the power to revoke the trust or return the trust properties. He can revoke the trust anytime, right? Or can take back all the asset from the trust. Grantors has the power to distribute the net income. They can distribute the net income. So income is taxed to the grantor as if no trust existed. Okay, so it's simply a very simple form, like if the grantor is holding all the interest in the trust, all the control in the trust, he is also the beneficiary, then the tax will be paid by the grantor only. The tax, like income, will be taxed as if no trust is existed, right? It will be simply a normal individual tax return. There will be no trust tax return. But if it's a simple trust, what do you mean by simple trust? If the trust has decided to distribute all the incomes which they have currently earned, then it's called a simple trust. Maximum distribution that the trust can make is fiduciary accounting income. We will see the calculation right after this, how we are going to calculate the distributable net income, how we are going to calculate the fiduciary's accounting income, how much will be taxable, how much distribution will be deductible, and everything we'll see right now. Okay, so maximum distribution is fiduciary accounting income. Okay, only up to that amount the trust can distribute, and the whole amount will be considered as a distributed currently if it's a simple trust. Okay, then allocation of the expense will be done based on the nature. For example, if it's an interest expense, right, it will be allocated to the interest income only. If it's a rental expense, it will be allocated to rental income only. One thing is, simple trust can get a deduction, a standard deduction I can say, of $300, and remaining will be taxable. If it's a complex trust, now what do you mean by complex? It's simple. If it's not a grantor, if it's not a simple trust, then it's a complex trust. Means their income are not allocated, they are not required to allocate all the income mandatorily in the current year. So for them, for complex trust, you will receive a deduction of $100. Got it, guys? Next is distributable net income. But before looking at this, I'll just take this example first. So let's take an example. Right now we are calculating about the simple trust. If it's a simple trust, how we will calculate it? Let's see. For example, in a trust, there are two beneficiaries. Okay. Expenses incurred for the trust are rent property expense for rent property tax. Rent property tax is paid off for 5,000. Then trustee's commission is there, that is $3,900. But out of this $3,900, $1,300 is related to principal and $2,600 is related to income. Now what is principal and income? See, whatever property is owned by the trust, it is called as corpus or principal. Means property. Whatever is the property, that is called as principal, I can say. Okay. Asset, I can say capital asset, so that is a principal. And on that asset, if you are earning the income, and on that income, if the trustee is getting the commission, right, then that is just considered as income. And if on the asset, on principal or corpus, if the trustee is getting the commission, then that is called principal. Okay. This bifurcation is necessary. We'll see in our next step. What was the income that was earned by the simple trust? First income is long-term capital gain of 15,000. Dividend income earned by the trust is 50,000. Rent income earned is 25,000. Tax exempt income is 25,000. Okay. So step 1, first and foremost, is fiduciary accounting income. How you are going to calculate fiduciary accounting income? Take all the incomes which are provided except long-term capital gain. You can even take the tax exempt income. You have to take the rental income. You have to take the dividend. But LTCG, long-term capital gain, you are not have to consider it as an income while calculating FAI, fiduciary accounting income. Okay. So we'll add all the income, that is dividend 50,000, rent income 25,000, tax exempt income 25,000. So our total income is 1 lakh. Out of this 1 lakh, how much you are going to distribute? First is rent property expense, right? Property expense 5,000 will straight away deduct it. But from trustee's commission, you are not going to allocate, you are not going to distribute this 1,300 because this is related to corpus. Whatever is directly related to income, only those amount you are going to deduct. So 2,600 only you are going to deduct out of the 3,900. Okay. So adding all the income, reducing the deductions, we get a FAI, fiduciary accounting income, that is 92,400 right now. Step 2, moving to the step 2. Step 2 is simple. Just take all the taxable incomes, again excluding the capital gain. So you will take rent income, you will take dividend. For tax exempt income, this is important, guys. For tax exempt income, that is 25,000, you will reduce the part of your gross, part of your principal commission which is paid. So how you will do that? So out of the 3,900, right, out of the 3,900, you are going to allocate it to the tax exempt. So divide by 1 lakh. 1 lakh was our total taxable. Multiply by 25,000, that is your tax exempt, right? So the 3,900 you will allocate, you will reduce the 3,900 for the tax exempt income part. Means what? 3,900 is allowed for step 2, but only up to the amount of taxable income. So what is your tax exempt? 25,000. So take the ratio. Out of 3,900 divide by 1 lakh, that is total taxable income, multiply by tax exempt income. Whatever is the amount, you are going to reduce it by 25,000. From 25,000, you are going to reduce it. Okay, guys? Got it? This is important part. Then you will reduce the deductions. From deductions, simple, you will get the rent property tax deduction. Now again, in trustee's income, whatever is your income, that is trustee's commission which you have paid, out of that you will take only the taxable income. So you know the 25,000 is a tax exempt income. So what is the taxable income remaining? See, LTCG you not have to consider anywhere in the step 2. So out of 1 lakh, your 25,000 is the tax exempt. So I can say 75,000 is the taxable income. So what you will do, the 3,900 you will not take a straight away deduction. You will take a deduction only for the part of taxable income, that is 75,000 only. So 3,900 divided by 1 lakh is the total taxable, multiply by 75,000, that is your total taxable, like apart from tax exempt. Okay, so we'll reduce these two deductions and you will get a DNI, distributable net income. So first step is clear, fiduciary accounting income. Second step is clear, DNI. In DNI, only the tax exempt part you will have to calculate. Whatever is your trustee's commission, the whole will not be allowed. Only up to the amount of taxable income it will be allowed. So whatever is for tax exempt, that should be eliminated. Okay. Third step is taxable distribution deduction. So out of this DNI, how much the estate can take as a deduction? First, we will add all the taxable income. What was the taxable income? 25 plus 50. Only the dividend and rent are taxable, right? Tax exempt we are not going to add. So add all the taxable income. We are going to reduce expense that are allocated to taxable income only. So from step 2, take only the 5,000 and 2,925. Because since only these two amount are allocated to the taxable income, right? We have adjusted it. 3,900 we have divided it by 1 lakh into 75. So these two are for taxable income purpose only. So we are going to take the total of 2 and we are going to reduce it from our taxable income. So taxable income minus allowed deduction. So this is your distributable deduction. So estate can take deduction only up to 67075. Estate can't say that I am taking deduction of 91,900. They can't take it. Only 67,075 will be allowed for the estate. So let's see for the trust, for the trust, how much is your income that is taxable. So all the income we are going to add, including capital gain, but excluding tax exempt. See, if it's a tax exempt, it's not taxable, right? So just take the rent, dividend and LTCG. So it's 90,000. We are going to reduce all the deductions. Two deductions are rental expense, trustees commissions, which are allocated to the taxable income. So 5,000 plus 2,925 we are going to reduce. Then whatever the trust has distributed, trust has distributed the whole income, but only up to 67075 will be allowed as a deductions. And then there is a personal exemption, that is $300 because it's a simple trust. So we'll reduce the 300. So this is how we come to a figure, that is 14,700 will be allowed as a taxable income for the trust. Got it, guys? I want you guys to solve this sum by your own. It covers whole concept of simple trust. All right. And then you can just go through this to theory. It is the same thing which is mentioned over here. So you can just go through it. Okay. Just the calculation I have taken so that it is easier for you to understand. Depreciation may not allocable depreciation to principal unless specific provision in the trust permits the trustee. See, for example, if there is an asset, right, the depreciation may not be allocable to the trust, but if there is a provision mentioned that the depreciation will be allocable to the trust only, then it is allowed as a deduction for the trustee, for the trust as a depreciation. If trust does not allocate the depreciation to the principal, right, deduction for depreciation passes through to be an income beneficiary. Whoever are the beneficiary, they will get the depreciation deduction. But see, for example, whenever you are taking here the expenses now, you can take a depreciation deduction if it is mentioned in the in the provision while forming the trust. If it is not mentioned, then you cannot take here as a deduction for depreciation. It will directly transfer to the beneficiaries, right? And they can deduct on their tax return. That's what it is mentioned over here. Okay, this was about the trust. Next is requirement for the trust tax return. When does the trust file the tax return? Trust will have to file the tax return, that is 1041 Form 1041 by 15th of April, and they can get an extension of 5.5 months, that is 30th of September. They can file Form 7004 as an extension and get themselves as an extended to file the tax return by 30th of September. And they will have to pay the estimated tax, and the dates are same as that of individuals, that is 15th April, 15th June, 15th September, 15th Jan. Okay, trusts are also required to file Schedule 1 to figure the AMT taxable income, income distribution deduction, AMT for the trust. Okay, the AMT you have already covered in the part 1. So make sure to go through it again. Though you are learning right now part 2, but still you have to go through the AMT topic in the part 1 and just look at it whether it's applicable to the trust or not. Okay, estate can use the fiscal year, right? But trust cannot use the fiscal year. They compulsory have to use the calendar year only, right? So that's it for the trust topic. Next, we are going to start with the farmers in the next session. Okay, so I want you guys to revise it again and again and again. See, cumulative revision will only be, key to success, I can say. It's not like that today you're doing chapter 1, chapter 2, and then chapter 3, 4 you're taking after 1 week. No, daily at least sit and revise one topic and then revise it cumulatively. So that's it for the day. Have a great day, guys, ahead. Tomorrow we are going to start with the farmers, and that is a very small topic, and rental property. Okay, so these 2 topics we are going to cover in the next session. So that's it for the day. Thank you. Have a great day.